The US dollar has lost a lot of value over the last 6 months or so. However, this could just be the start of a long-term decimation of the dollar's value on a global scale. With the US economy weakening and speeding headfirst into a recession, alongside a totally unsustainable fiscal policy from the government, large institutions and central banks are rapidly losing faith in the US financial system and are moving away from the US dollar. And it is now becoming clear that there are a couple of assets in particular that they are flocking to as a safe haven instead to mitigate further downside risk of the US dollar. So the US dollar recently hit a new low for the year, with this month being particularly bad, with the US dollar falling by 2.2% against a basket of rival currencies in August, now at lows not seen since the start of January. Now, investors are bracing themselves for interest rate cuts, and markets are now pricing in 3 or 4 Federal Reserve rate cuts of 25 basis points each, which is a bad thing for the dollar's value. Now, this is partly due to recent bad economic data coming in, including a weak US jobs report and a surging unemployment rate. Lowering interest rates makes a currency less attractive for foreign investors to hold, which means that there is less demand for the currency and generally leads to a depreciation of the currency. And the Conference Board's US Leading Economic Indicators Index has just declined for the 29th straight month, taking us lower than the lows that were seen during the pandemic fear in 2020, now at lows not seen since 2016. Citi's US Data Change Index has also indicated from late June that US economic growth was slowing faster than that of other advanced economies compared with the past year. And Citi also did say that its hedge fund clients have been consistently net US dollar sellers since August the 7th, with the bank's US dollar positioning indicator currently being the most bearish it has been since May of 2021. And on top of all of this, we are seeing the US government's budget deficit continue to widen, which is forecast to only get worse over time, leading to more and more borrowing and an exponentially increasing national debt. But aside from the internal problems that the US is facing right now that could lead to a further weakening of the dollar, we are also seeing a number of concerning things happen internationally, fueling a continued de-dollarization process. A new bombshell BRICS payment platform that would ditch the US dollar entirely is being worked on and is gaining support from numerous central banks across the world. The BRICS bloc was established to compete against the US dollar and originally included China, India, Russia, Brazil and South Africa, all countries with massive economies and also large trade partners with the United States. And in 2023 and 2024, the organisation did add several other countries, including oil giants Saudi Arabia, UAE and Iran. Now, the BRICS organisation continues to gain momentum and is now garnering serious interest from dozens of other countries across the developing world. More than 50 countries could move to accept this new BRICS payment system once it is established and approved, which reportedly will not integrate the US dollar into the mechanism and allows countries to settle trade in local currencies. Forcing the United States to settle trade in local currency when trading with all of these nations would pose a threat to the US dollar, as it does increase the demand for the local currencies while also decreasing the demand for US dollars. This collectively will strengthen these local currencies, weaken the US dollar, and erode away at the dominance that the US dollar currently holds over currency trading, which currently accounts for close to 90% of all currency trading, according to 2022 data from the Bank of International Settlements. China specifically moving away from the US dollar is going to be detrimental to the strength of the US dollar, and just recently we have seen the Chinese RMB overtake the US dollar in China's cross-border payments. The Chinese RMB is growing in popularity in payments both domestically and also globally too, and here we can see just how much things have changed from back in 2010 when just 0.3% of China's cross-border payments were settled in Chinese RMB, with 84.3% being settled in US dollars. And over time we have just seen a deterioration of the US dollar dominance, which is only likely to continue to deteriorate in the future. This trend is certainly a problem for the US dollar's strength, and the US conducted close to $600 billion worth of trade with China in 2023, with the majority of this trade being imports from China, and it does make them the US's third largest trade partner behind Canada and also Mexico. Now, China is also continuing to distance themselves from US debt ownership and are quickly reducing their holdings of US Treasuries, which has fallen from a peak of over $1.3 trillion back in 2014 to now being at around $750 billion. Now, this Chinese sell-off of US Treasuries has only accelerated since the pandemic, which coincides with when the US national debt started to surge uncontrollably as the government continues to borrow more and more money and running large budget deficits. Now, this suggests that China is also losing faith in the US fiscal and monetary policy and believes that the out-of-control government debt situation is unsustainable and does pose a big risk to owning US Treasuries. Now, as long as the US government continues to issue new debt to keep paying for the sky-high interest payments on existing debt, the intrinsic value of every dollar is going to keep decreasing, and these existing treasuries are also being devalued as loads of new treasuries are being issued and pumped into the ecosystem. Now, with the dollar likely to continue to be devalued with the precarious fiscal and monetary policy situation in the US, an imminent recession likely, and the continued de-dollarization process being carried out from the BRICS countries, gold demand is growing rapidly. This is clearly being reflected in the price of gold as an asset performing really well in the last year or so, with the largest gold ETF, the SPDR Gold Trust, being up over 21% in 2024 so far. Now, demand from central banks for gold has really ramped up over the last few years, and 2022 and 2023 saw huge demand relative to previous years in recent history. Now, in the first half of 2024, we have seen central banks buy up 483 tons of gold, more than ever before in the first half of any year. This means that 2024's gold demand is on pace to break new records and potentially exceed any previous year. Now, the US remains the country that owns the most gold as of 2024. However, this is not where the surge in demand for gold is coming from, as Russia and China are massively leading other countries in terms of the most gold that has been bought over the last 10 years. Now, this once again points towards a de-dollarization process amid escalating geopolitical tensions and increased sanctions. And it is not just the global central banks that are becoming more interested in gold though, as Western investors are also buying up lots of gold as well. Marcus Garvey, head of commodities strategy at Macquarie, did say, "From a flow perspective, it is quite notable that it's coming much more from Western investor buying than anything else." And if there is one chart that perfectly displays just how much investors and central banks are losing faith in the US financial system and are now resorting to holding defensive hard assets, it is this one here. This compares gold prices to US Treasury prices, clearly showing the decoupling that we are now seeing between the two assets. Similarly, this chart does show the correlation between real rates and the price of gold, also showing a huge divergence between what was once a very closely correlated relationship. In other words, the value of US Treasuries is vastly lower than where it has been across history relative to the price of gold, meaning that the yield on these US Treasuries are vastly higher. Now, while the US dollar is certainly not going to collapse anytime soon, the data certainly does suggest that we could be looking at a longer term deterioration of the US dollar, and gold seems to be the asset of choice that institutions and central banks are using to hedge against a weakening dollar. However, international equities is also another asset class that could benefit from weakening dollars. International stocks denominated in their home currency do gain value from a weakening dollar, and they also do have the benefit of being less exposed to US-orientated economic situations like recessionary periods or a declining fiscal situation where national debt is surging uncontrollably. The declining economic situation in the US could soon be reflected on the US stock market too, as we are seeing valuations becoming increasingly high and resemble a bubble more and more by the week, with a surge of selling now taking place from large institutions like Warren Buffett's Berkshire Hathaway, as well as insider selling from company executives. My previous video goes into more detail on this topic. You can check it out by clicking on screen right now. Aside from that, if you did enjoy the video, please be sure to leave a like and subscribe, as that does help out the channel a lot, and thanks a lot for watching.